Hey everyone, and welcome. In this video, we are going to break down ICT's complete playbook for finding and managing high-probability day trading setups. So if you're looking for a structured, rules-based approach for your trading, you are definitely in the right place. Welcome to AI Explains ICT. What we're covering today comes straight from the core content, Month 8, Episode 7. We're about to get into some really detailed high-probability setups, so if you're a day trader, you're going to want to grab a pen and paper for this one. All right, so here's the game plan for today. We're going to start with the absolute most important idea, the core principle that guides every single trade. Then we'll dive into the specific playbooks for both buys and sells, what to look for, and how to manage the trades. And finally, we'll cover the rules of engagement, which is all about the mindset you need to actually pull this off. Okay, first things first. The entire foundation of any high-probability day trade, according to ICT, is making sure you're aligned with the higher time frames. This isn't just a suggestion, it's pretty much non-negotiable. So here's how that core principle works in practice. Your number one job, before you even think about a trade, is to figure out the directional bias from the daily or the 4-hour chart. If that higher time frame is bullish, you are only looking to be a buyer. You're just waiting for the price to pull back into what we call a discount area to get in. On the flip side, if the bias is bearish, you're only a seller. You're waiting for the price to rally up into a premium area to look for shorts. It's that simple. And this right here shows you the key battlegrounds for pretty much any trading day. The previous day's high and the previous day's low, these are like giant magnets for price. Why? Because that's where all the liquidity is. Above the high, you've got buy stops, below the low, sell stops. The market is constantly drawn to these levels, and understanding this is absolutely critical for framing a good setup. Okay, so let's get into the bullish playbook. We're going to break down the exact conditions you need to see to identify a really solid, high-probability long setup. So when are the conditions just right? You can't just buy every little dip, right? The market has to give you a very specific set of environmental factors first. Here's the exact checklist from ICT. First, your higher timeframe bias must be bullish. No exceptions. Second, there has to be a clear, open road to a higher price objective. We're also looking for setups early in the week, Monday, Tuesday, or Wednesday, because that's usually when the big weekly moves get started. The sweet spot for time is the London kill zone, between 2 and 4 a.m. New York time. And this is crucial. We want this to happen after a really quiet Asian session with a range of 20 pips or less. That quiet consolidation is what builds up the energy for an explosive move. All right, so the environment is right, the timing is right. Now, where exactly do you look to get in? What are the specific patterns we're hunting for on the chart? Now, this is really interesting. Notice the focus here on buying below lows. We're not chasing price up. We're looking for a run on sell-stop liquidity. So this could be a quick dip below the Asian range low, a move down to fill a fair value gap, or a nice retracement into a clean, bullish order block. We're also watching for price to stretch 1 or 2 standard deviations below those established ranges. And of course, there's the classic turtle soup, a false breakout below a significant low that traps sellers. And here's a perfect picture of one of those setups in action. You see how the market makes that short-term low, then it trades down below it, right into that bullish order block. When your higher time frame analysis is bullish, this is an A-plus entry scenario, especially during that London session. You know, getting the entry right feels great, but that's really only half the battle. A true professional manages the trade with a clear, rules-based plan for both their stop loss and their profit targets. Your stop loss is not based on a feeling. It's mechanical. It's determined by the specific setup you took. And as you can see, ICT gives you precise rules for each entry type. For a run on the Asian range, it's 40 pips. For that turtle soup, 30 pips. And for an order block retracement, it's a tight 10 pips. The most important thing here, set your stop based on these rules and then let the trade breathe. Don't make that classic mistake of choking your trade by moving the stop to break even way too early. Taking profit should be a multi-stage process. The first rule, and it's a big one, is to always take a partial profit at 20 to 30 pips, no matter what. Pay yourself first. After that, you start scaling out at key technical and statistical levels, every 2 standard deviations of the Asian range at the previous day's high, and then the big target is when price hits its projected average daily range. You also have to be aware of time, maybe taking some profits off the table before those key New York session windows open up. Awesome. Now that we have the full bullish framework down, let's just flip the script and look at the other side of the market. The good news is, the logic for finding high probability shorts is a perfect mirror image of everything we just talked about for buys. So just like with the buys, we have to wait for the right environment. We're waiting for the market to give us a very specific set of conditions before we even think about looking for a short entry. And look at that, the checklist is almost identical, just flipped on its head. Higher time frame bias has to be bearish. There needs to be a clear shot down to a discount level. Again, we're focusing on the early part of the week, during that London kill zone, right after a tight consolidating Asian range. We're basically looking for that Judas swing higher to sell right into. Okay, so all the conditions are in our favor. Now we start stalking the chart, looking for those specific price action patterns that signal a high probability entry to go short. The logic here is perfectly symmetrical. Instead of buying below lows, now we are selling above highs. We're looking to take advantage of a run on buy-stop liquidity. So this could be a spike above the Asian range high, a move up to fill a gap, or a retracement into a nice bearish order block. And, you guessed it, the bearish turtle soup sell, a false breakout above a key high that traps buyers. And just like with our long trades, a professional entry is always followed by professional trade management. So let's look at the specific rules for placing stops and taking profits when you're in a short position. Once again, the stop-loss rules are mechanical, they're based on the setup. For a run above the Asian range, your stop is 40 pips above your entry. For a turtle soup sell, it's 30 pips above that high you were targeting. These rules give you a clear, objective framework for managing your risk on every single trade. It takes the emotion out of it. And the profit-taking strategy? It's exactly the same as the long side, just inverted. Rule number 1, you take something off the table at 20 to 30 pips of profit. From there, you just systematically scale out at your key levels, those statistical deviations, the previous day's low, and the projected daily range, all while keeping an eye on the clock for those key New York session time windows. Okay, let's wrap this all up with what might just be the most important part of this whole video, the mindset and the rules of engagement that you absolutely need to use this information the right way. ICT makes this point crystal clear with this quote. This is not some simple plug-and-play robot system where you just follow a checklist blindly. This is a framework that requires you, the trader, to actively analyze the market and think for yourself. So the biggest thing to take away from all this is that this is a playbook, a framework. It is not a magic formula. You're not going to find every single one of these criteria lining up perfectly on every trade. Your job is to study this framework, really internalize the logic, and then analyze what the live market is offering you on any given day. Yes, it requires work and it requires study, but in return, it gives you a consistent professional process to follow. So there you have it, a complete framework for high probability day trading. If you found this breakdown useful, do us a favor and hit the like button and subscribe to the channel. It really helps us make more content just like this. And if you have any questions at all, drop them in the comments below and a real human will get back to you. Until next time, good luck and safe trading.